Now, I can do one of two things. I can either start spending 100 hours a week trying to find what are the new and emerging opportunities, or I can find someone like Intelligent Investor who's got a track record of doing the work for me. Intelligent Investor's it's my turbocharger.
Hello, I'm Tony Kaye. I'm the editor of Eureka Report. Welcome to the Economic View. I'm joined as usual by Callam Pickering, our economics writer.
Great to be here.
Good to have you, Callam. Callam, I wanted to talk about what's happening in the US economy and also talk about what's happening in the Australian economy in terms of moves by APRA to slow down housing investment. So firstly, on the US economy, saw some data out last week regarding jobs, which seemed to indicate that there had been a slower than expected growth in jobs.
Yeah, so the US employment survey came out on Friday night, our time, and it was a little bit of a mixed report for the United States. So non-farm payrolls came in a growth of 98,000 in the month of March, which was somewhat weaker than expectations of around 180,000 jobs. Now, there were some reasons why it fell short. There was some weather-related effects that may have increased February and put some downward pressure on March. But nevertheless, it was a fairly weak result compared to what the market expected. But this was offset by actually some strength in the unemployment rate. So the unemployment rate actually fell to 4.5% from 4.7% back in February, which was actually the lowest level in about a decade. So while the employment figures weren't necessarily fantastic, the unemployment rate continues to head in the right direction from the perspective of the Federal Reserve, which suggests that these labour market figures probably aren't going to affect the timetable for the Fed in terms of when they decide to increase rates next.
Yeah, that's what I was thinking actually, that lower than expected numbers in that area was going to, potentially work against what they were doing with rates. So not so.
Yeah, I can't imagine it's going to affect them too much. Employment growth has been quite strong over the past 6 months, with the exception of the most recent outcome. If job growth does rebound next month, then I expect it'll be business as usual for the Fed.
Okay. And just getting on to our own market then in terms of rates and what's happening in the housing sector in particular, we've seen APRA and a whole lot of other people come out in the last week or couple of weeks talking about steps to slow down the Australian market. We've seen rates creep up slightly amongst lenders. So what's your view on where that's at the moment?
So there's certainly a lot going on in the housing market at the moment, and our three major regulators, the Reserve Bank, APRA and ASIC, have certainly had a lot to say in the past couple of weeks with regards to investor activity and the fact that it's running a little bit hotter than they are currently comfortable for. Now, APRA came out over the past couple of weeks and they've said that, look, they're going to limit the rate of interest-only loans as a share of new mortgages issued to 30%, which is down from around 40% currently. Now, Australians by international standards tend to rely more on interest-only loans than other countries do. So this is a pretty big change for the investor segment. Interest-only loans account for around 2/3 of investor lending. So that shift is going to weigh on investors to some extent. More recently, last week, APRA came out and said, look, we may have to look at higher capital requirements for the major banks. So the major banks would have to hold more capital against their mortgage assets. Now, we know from previous capital raisings that this is likely to weigh on the return on equity that the banks achieve, which is obviously going to affect their value from an investor standpoint.
I was looking at the latest results, auction results, and they're still, especially in Melbourne and Sydney anyway, still staying very strong above that 80% level. So when this does bite is probably going to be a little bit further down the track from where we are now. It's not going to be sort of an instantaneous thing in terms of property investors.
It certainly seems that way. Property investors have proven to be more resilient, I think, than our major regulators expected. I think they thought that they could step in, put through some macro-prudential measures and investors would sort of draw back. But that certainly hasn't been the case thus far, and I think investors are probably going to take the recent changes in their stride, at least for now, And I wouldn't be surprised if they remain quite active in the market until interest rates begin to climb. And that'll probably come through as the Federal Reserve begins to hike over the remainder of this year, because as they do that, our major banks are going to pass that along to domestic investors.
Yeah, we've already seen a bit of that. In terms of the Reserve Bank moving rates, though, a lot of expectations are that not a lot is going to happen this year. But maybe into 2018 we might see some rate rises. Well, the first move will be up anyway from the Reserve Bank.
Yeah, certainly the Reserve Bank central scenario at the moment is that they won't be doing anything with interest rates over the remainder of 2017. There is some debate over what the next move for the Reserve Bank will be, however. My personal view is that as commodity prices do come down, it's actually going to put some pressure on wage growth and inflation, and could prompt the Reserve Bank to maybe even cut rates again, particularly if the major banks do continue to raise rates as the Federal Reserve does hike. So if our major banks were to increase rates by, say, another 20, 25 basis points over the remainder of this year, the Reserve Bank may actually feel that they need to offset that to some extent by cutting as commodity prices skew lower.
Which will be quite interesting to see the gap widening between the official rate and what the lenders are actually charging in the marketplace.
Yeah, that's right, and that's a process that has actually occurred ever since the global financial crisis. There used to be quite a stable spread between mortgage rates and the cash rate, but that spread has widened consistently over the years, and we've seen it very much so in the last 12 months, and I expect that we'll continue to see that spread widen over the next couple of years.
Yeah, it'll be interesting to see, and also it's going to be really interesting to look at all the data coming out of the housing market, say, over the next few months to see what sort of impact these off the books rate rises have had.
Yeah, that's right. I think our regulators are going to be closely watching this data. Certainly I'll be closely watching this data to see whether investors remain as active as they have been over the past 12 months, where we've seen new mortgage lending increase by around 25% for the investor segment. Does that continue, or does it slow down? And if it doesn't slow down, what does that mean from a regulator perspective? Are they going to introduce new measures to slow down investor lending? So it's a very interesting dynamic at the moment, and I suspect that there'll be plenty of interesting developments that will occur over the next few months.
Yeah, and I think property investors in particular will be quite anxious to see how all this pans out for them, in terms of still fairly strong property market, rates rising, steps being taken to curtail interest-only loans. So there's a whole lot of factors at play here. It'll be very, very interesting to see how it pans out.
Yeah, absolutely. There's a number of headwinds for investors right now, and while they have remained quite resilient over the past couple of years in the face of these headwinds, it becomes a question of when does it become too much? When does this hot housing market begin to cool off a little bit, and these new regulatory measures begin to weigh on investor sentiment? There's certainly plenty of debate about when that'll happen, but it's hard to see the housing market remaining as hot as it currently is over the next year or two.
Oh, well, thanks, Callam. Thanks for joining us again.
Thank you.
Join us again next time for the Economic View.